For today's main topic, we're going to be reading through and reviewing an article that was put out by Zion's Bank. Zion's Bank is primarily out in Utah. I got an email from the bank with a link to this article entitled Three Ways Rising Interest Rates May Affect Your Personal Finance. I thought with today's continuing to rise rates in early 2023, that it would be important to look back at what the initial reaction was here from Zion's and see what was healthy, what they got right, and if there's anything that we can expound on in order to help you understand the best way to approach these high interest rate times in 2023. So let's begin. Again, the article is Three Ways Rising Interest Rates May Affect Your Personal Finance. The article was originally published in June of 2022 and updated in September. Still relevant information, but rates have gone up since then. We got to keep that in mind as we go through. So the first point that they have in this article is that rising interest rates should impose a consideration on mortgage rates and home buying. As the Federal Reserve has been raising rates, the thing that it seems to be impacting the most is the demand for mortgages. Interest rates dropped so low that it was crazy for me to not refinance in that time. I think we refinanced out in Utah and got a mortgage rate that was around 2 to 2.5%. I don't think rates are ever going to be that low again. I think if you want to wait for rates to come back down, I don't think you can ever expect them to go down that low, at least in the near future. We're in an environment now where the Federal Reserve is wanting to keep rates higher in order to suppress how hot the mortgage market is. The demand and prices rising in the housing market is a huge driver in inflation. And when your cost of living goes up so much in the housing market, it's going to be reflected either by causation from one to the other. This is why homes and owning a home, owning real estate is considered to be a good hedge against inflation. When inflation drives the prices of everything up, when rates get raised by the Federal Reserve, your home value should go up. And this acts as a buffer to protect your net worth from what crazy interest rates can do. So let's read what the article says. Over the last few months, mortgage rates have risen in anticipation of Federal Reserve rate hikes. As the Federal Reserve continues to increase rates to fight inflation, home buyers will see mortgage rates continue to rise. Although mortgage interest rates are historically low compared to previous generations of homeowners, it's important to understand how higher rates affect affordability, says Spendlove, someone that they're quoting in the article. With every 1% increase in mortgage rates, you can expect approximately $300 per month on a $500,000 mortgage. This really puts going from a 2.5% to a 4.5%, 5.5%, or 6.5% mortgage into perspective. Let's say you had a mortgage that was half that. Well, every 2% that goes up is going to be adding around $300 to your monthly mortgage payment. With the rising interest rates that we have, what we're seeing since the pandemic, couples and families and individuals who could afford a $500,000 or $600,000 home because rates were so low are now being pushed into a totally different bracket of housing. It's slowing down the demand for moving. Those who were able to get into a bigger and nicer home, they're not wanting to get rid of it, so they're not putting it out on the market. It's helping prices be sustained. I digress. Let's keep going through the article here. If you're in the market for a home, getting ahead of rising interest rates could save you thousands of dollars over the life of your mortgage. To help offset rising interest rates, many buyers are leveraging adjustable rate mortgages, which typically have introductory interest rates lower than 30-year mortgages. Huge red flag here. Huge red flag. Adjustable rate or ARM mortgages are absolutely terrifying. I remember out in Utah, I was talking to a client and discussing how adjustable rate mortgages can be dangerous to the consumer. And they responded to me with a story of how early on in their marriage, they had an adjustable rate mortgage. life happens, life changes, and then the interest rate goes up, typically like 3 to 5 years into the adjustable rate mortgage. And when that rate spikes and the bank has the right to move it up, your mortgage payment is no longer consistent and stable. It's no longer predictable, and it can easily put you into a situation where you are house poor. If you are so desperate to be getting into a home right now, instead of looking at an adjustable rate mortgage in order to get yourself into that house at a lower interest rate, I would much rather you, instead of considering a 15 or a 20-year mortgage, consider a 30-year mortgage or lower your budget for the time being. Just because the instability of that mortgage, that adjustable rate, it can put you in a position where you have to go through a foreclosure because you cannot afford those payments. And if life happens and you don't have the situational evaluation that permits you to refinance, you might not have the ability to refinance that adjustable rate mortgage later. You may be denied refinance everywhere you go, trying to get something that's more stable. And if interest rates are still really high when you try to do that, you might be just trying to refinance into a situation where your payment is even higher after the adjustable rate spiked. So if you're in the market today, don't jump into an adjustable rate mortgage. That's my opinion. Don't Jumping into an adjustable rate mortgage puts you at a great deal of risk of a future foreclosure. So I disagree with the advice in this mortgage, although they don't phrase it as advice. In all fairness to the article, they phrase it as a way that homebuyers are currently offsetting the rising interest rates. They don't say that it's the way that they would recommend. I think it would be dangerous to say that as a mortgage provider that they would recommend an ARM over something else. For those who lived through the 2008 housing crash, in 2008 with adjustable rate mortgages or subprime loans, there were so many of them out there that all had the rates spike at the same time. Foreclosures were through the roof, and that's what made mortgage securities drop so much in value. And those big banks and financial industries that were putting derivatives on mortgage-backed securities just lost their shirts. And that's why the 2008 housing crisis was one of the biggest financial crises in modern history. Just in my opinion, if it were up to me, adjustable rate mortgages wouldn't be a thing. Too much risk for my taste. Second point on the article: rising interest rate consideration number 2, credit cards. Because interest rates on credit cards are usually not fixed, they're particularly susceptible to changes in the federal funds rate. If you are carrying credit card debt, higher interest rates will likely cause your minimum payments to rise and also make paying off that debt harder. Consumers with credit card debt should consider strategies to offset rising interest rates, says SpendLove. If you have good credit, you could consider a credit card balance transfer. And regardless of where rates are, it's wise to reduce your credit card debt whenever possible. Okay, I agree that it's important to reduce your credit card debt. I would say it's wise to have no credit card debt whatsoever. And this article makes a great point in saying that the massive risk of credit card rates being something that can ebb and flow and go up and down and affect your minimum payment. You have to understand, on credit card, minimum payments are not necessarily the minimum payment in order for you to get things paid off over time. Some credit cards, because their interest rates are so high and the range in which minimum payments fall, you might be making the minimum payments, but your balance is going to be continuing to grow because your minimum payment just isn't enough to make up all the interest that your credit card is racking up that month. In the context of rates, let's think back to the mortgage rates. We think now that a 6 to 7 or 8% mortgage rate is really high. The average credit card rate, the average, is over 19%. It's almost 20%. It's a smaller balance that's typically carried on a credit card, sure, but that kind of interest rate, that's just not frugal to be paying so much interest on any balance carried on a credit card. And with rates going up higher, it's all the more important to be getting out of credit card debt. It's just essential in order to protect you from the risks of not only rising interest rates, but that liability of having that unsecured debt that could lead to collections and lawsuits down the road, or a credit card balance that's so large that in a tragic situation like you lose your job or you have to take a pay cut, you can no longer service that balance that you're running on your credit card. It puts you in a position where you can trash your credit. It puts you in a position where you're putting your financial well-being and your financial peace at risk in an undue way. So I would say get rid of the credit cards and their balances altogether, just in order to stay away from the risk. We talked about it on episode 3 of the podcast, that prudence is going to be an exercise of reducing risk. So to be frugal, we want to minimize the risk to our financial well-being. And credit cards are nothing but a liability if you're carrying balances on them month to month. I think it's only 13% of Americans who are actually paying off the balance every month, and they're not carrying anything. The rest of America is paying interest at least every once in a while on their credit cards. And that's just something that we can't afford to be spending right now, as everything's going up with inflation, and we have to make sure that what we're putting our money to is intentionally meeting our needs, our utilities, and the bare minimum, covering our 4 walls, and the priorities and things that we hold in higher regard in our life, not the profits of a bank. Whew, I gotta calm down. Okay. The other thing it says here is consider a credit card balance transfer. Some credit cards, if you have a good credit rating, you can qualify for a credit card that has 0% interest rate for like the first 12 months, first 6 months, typically a promo deal. That way, as you're trying to pay off the card, it's no longer racking up interest, and as you're wailing on it, you can knock it down. The risk in doing this is that you might feel that you've actually made some sort of progress in your paying off debt journey by getting rid of the growing interest, and you might feel like you can lean back like you did something. The debt is still there, and if you don't pay it off before that interest kicks back in, you've done nothing to help your situation. And if you start adding more onto that card, then you're just raising the balance that you have to pay off later, and that's going to be just obliterated by high interest down the road. Again, the average credit card interest rate is over 19% today. It's crazy. So there's a third point in this article, rising interest rate consideration number 3. That's going to be your savings accounts. Now this one's going to be positive. We can take a deep breath. Higher interest rates are welcome news for people who like to save. Although there isn't a direct link between the federal fund rate and deposit rates, financial institutions generally increase the annual percentage yield that is paid for money market accounts, savings accounts, and CDs as the Federal Reserve rate increases. You should anticipate your bank will raise rates to attract deposits. This is true. Back when we were in those historical low rates for mortgages in 2020, in the heat of the pandemic, and interest rates were around 2% for a mortgage, a CD, a certificate of deposit at a bank, was making almost nothing. If you were to invest in a CD at that time, it would be making what a high interest savings account is going to be able to make you now. The way the CD works, if you're not familiar with the CD, it's going to lock your funds. It gives you a higher interest rate than a standard savings account at the bank by reducing your liquidity, or how frequently you can access that money. You basically say, yes, I'm going to lock this away. I'm not going to touch it for the period of time that it takes for that CD to mature. And locking away money back in 2020 with super duper low interest rates was just not something that was appealing to almost any investor and any saver out there. When it comes to savings, you can look now, if you have a high interest savings account or a money market where you store, say, your long-term savings or your emergency fund, it might be a good time with the rising rates to shop around a little bit and see if there's another account out there, another bank that's providing a higher return on that money that's sitting there. For your emergency fund, you want to make sure that you're not putting it in something that's going to trap the liquidity away, like a CD. You want the emergency fund to be accessible. But with an emergency fund, it's a sizable amount. 3 to 6 months of your expenses is what HopeFilled Financial Coaching recommends. It's what I would recommend, and it's what almost every financial guru out there recommends. 3 to 6 months of your expenses. And that can be a lot. So it might be a good time to shop around for a new high interest bank account or money market. I think that's something that we can take away from this. If you have extra cash on hand, rising interest rates create opportunities for you to leverage, says Spendlove. If you've paid off debt and don't need access to cash right away, you may benefit from depositing funds in a CD. You'll receive the benefit of a fixed interest rate compounded daily, meaning you'll receive interest calculated on your initial deposit and accumulated interest. Yeah, the idea of a CD, if you have money that you don't want to invest in the stock market because it's too volatile, and it's money that you don't think you need to have access to, so that would be over and beyond an emergency fund. You could drop it in a certificate of deposit. I think that's all right. I mean, they make much better return now than they did in 2020. We talked about that. What you want to look at, though, in your personal financial plan as you're working for it is, what is the purpose of this money? When you have savings pooled in a savings account, it can be really helpful to break down that savings into different purposes. That's something that we'll talk about in future episodes. It's called a savings allocation plan. It's something that I practice. I don't want to have a dollar saved or a dollar flowing through my checking account that doesn't have an allocated purpose, even if that purpose is just general wealth accumulation or general savings for who knows what down the road. But I want to have priorities like replacing the roof, replacing the car, replacing the computer earmarked so that I know that I have the money ready to go for those things that are coming up. It's just like stacking the books that I did in college in order of priority. You want to make sure that you're meeting the things that are going to be coming up sooner and what you're saving for and what's on your budget. You want to make sure that in your budget, you're covering the four walls, the very tip top of your pile, the very top of your priorities before you start engaging in anything like investing in extracurricular things in CDs or money markets over and beyond that. You want to make sure that you have the ability to achieve everything that your life demands of you now before you go out and start testing the waters because of the new and appealing rates that are out there. Don't jump at it and go, wow, this is so amazing. It's the opportunity of a lifetime, and spring for it. If you haven't gotten out of debt and you are looking at your pile of debt and it comes to a point where they go into collections, you want to get rid of this debt now, but all your money is trapped in CDs, and to pull it out, you acquire a penalty, or you just can't. You don't want to put yourself in that situation. You want to make sure that you've covered your priorities in an appropriate order. If you go to HopeFilled Financial Coaching website, that's going to be hopefilledfinancial.com. On our homepage now, we list the HopeFilled Footsteps. That's going to outline the path to financial success. I sincerely invite you to visit the website and go check out those footsteps. We'll be covering those in a future episode of the podcast. But for now, those steps that are outlined on the website represent the pile of priority that you should be going down before you start investigating and jumping at something that's a really exciting investment opportunity. To conclude the article, it says that rising interest rates make it critical to manage your financial obligations. Amen to that. It's important to be aware of how rising interest rates will affect your personal finances. Our debt calculator, this is just an ad for Zions Bank. I'm not sponsored by them, by the way. I did bank with them for a period of time. That's why I'm on their mailing list. Our debt calculator can help you determine how much you owe, how much interest you're scheduled to pay, and how long it'll take to pay it off. If you're on a path to getting out of debt, a debt calculator can help you figure out how long you have to go, but it can also suck some of the motivation that you have from you. If you're trying to get out of debt, one of the most effective and efficient ways is to just list the debts, smallest balance to largest balance, and knock them out as fast as possible. This is called the debt snowball. Debt snowball, popularized by Dave Ramsey. The last paragraph of the article here says, by calculating how rising interest rates will affect your personal finances, it will be easier to make a plan that will save you money over the life of your loans. Making financial decisions with rising interest rates in mind can help position you for financial success. I don't think that rising interest rates necessarily dictate every chapter that we have in our personal financial journey, in our goals, in the hope-filled path to financial success, in the 8 hope-filled footsteps. I think it's more important for us to know what our plan is for financial success and to be cognizant of rising rates. I think rising rates simply put a big red light over the fact that we need to be extra intentional and extra frugal with our financial plan. We need to emphasize the importance of a budget, and we need to know where our money is going. With rising rates, it's going to be all the easier to fall into paying extra fees and higher interest on debts, especially credit cards. And we want to mitigate that so that you can be taking your biggest wealth building tool, your income, free it from debt, and channel it into building wealth beyond reason and achieve those hope-filled financial goals that you have for yourself and your family. Next week is Valentine's Day. So we're going to have a special episode on Valentine's Day. I'll be doing an interview with my wife, and I hope that you can join us then. Until next week, budget bravely and enjoy your hope-filled financial future.